Welcome to the Deep Dive, the show where we really cut through the noise. We untangle complex info and pull out those key insights from your sources. Today, we're diving headfirst into something that, let's be honest, can feel a bit like wading through fog for many people. But it's absolutely critical for understanding a company's real financial picture. We're talking about impairment loss.
Ah,
Specifically for those long-lived assets, property, plant, and equipment, PP&E. Our goal here, simple. Give you a clear, concise grasp so you feel informed, not overloaded. So you know how companies list big assets like factories or machines on their books, usually at historical cost minus depreciation. That's the carrying amount. But what happens when the value of that asset just tanks unexpectedly? What if it's not going to bring in the money the company thought it would? Well, that's exactly where impairment kicks in. It's like a reality check in the financials, acknowledging, hey, this thing isn't worth what we thought. Okay, before we go any deeper, just a quick reminder. This deep dive draws heavily from material provided by Farhat lectures. All the content, the examples, the explanations we'll discuss, it's all derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe studying for the CPA exam, or you're already a professional, definitely check out the website. They've got extra practice questions, video lectures, and loads of support to help cement what we talk about today.
A big thanks to Professor Farhat for this great material.
All right, let's get started. The big question first. What is asset impairment, fundamentally? And why should anyone looking at financials, well, why should they care? We know about the carrying amount for PP&E, but sometimes things happen that drastically slash the future benefit or usefulness of those assets. You can't just ignore that, right?
exactly. You can't. Impairment really is just a reduction. It's when the recoverable value of one of these long-lived assets drops below its carrying amount, below what's on the books. Think of it like this. The asset simply isn't going to earn back its keep. It won't generate the cash flows of the benefits that were originally expected. And why it matters? Oh, it matters hugely. Accounting rules demand that financial statements show this diminished value accurately. If a company doesn't recognize an impairment, well, they're basically painting a rosier picture than reality warrants. It's about honesty, transparency. It shows management is facing facts about their assets.
That makes perfect sense, reflecting economic reality even when it's not great news. So how does a company figure out it might even have an impairment problem? What are the triggers, the red flags that say, hey, maybe take a closer look at this asset?
Good question. There are several common signs companies watch for. The most obvious is a big, significant drop in the asset's fair market value. Imagine, like, a piece of tech suddenly becomes obsolete because something way better just came out. Its value just collapses.
Right. Obvious one. What else?
Another big one is major changes in how the asset is used.
Yeah.
Or, the extent it's used. Maybe a factory cuts production way back, so the equipment sits idle more often. Then there are adverse shifts in the legal or business climate. New regulations could make a plant too costly to run, maybe.
Or consumer tastes change and the product line tanks.
Exactly,
Mm.
rendering the production assets less valuable. Also, watch out if costs to acquire or operate the asset balloon way past what was expected. That makes it less cost-effective. And finally, a big one, projected ongoing losses that are directly tied to that asset's operation. If it's just losing money consistently.
Hmm.
Any of these signals basically tells management, hold on, this asset might not pull its weight anymore, it might not recover its book value. It forces them to ask, will this really deliver?
It's fascinating, really. It connects the accounting directly to, well, real-world business shifts and economic forces. It's not just numbers in a vacuum. Okay, so a company sees a red flag. They don't just immediately write it down, though. You mentioned US GAAP has a specific process, a two-step test. Let's unpack that.
Yeah,
What's the very first check, the first hurdle? Seems like a screening step.
precisely. It's a gatekeeper. Step one is called the recoverability test. And here, the company does a really key comparison. They estimate the undiscounted future net cash flows they expect to get from using the asset and eventually selling or disposing of it. Then they stack that total up against the asset's current carrying amount.
Undiscounted. Okay.
Yes, undiscounted for this step. Now, if those future cash flows are more than or equal to the carrying amount, great. No impairment. The asset's considered recoverable.
Hmm.
You stop right there. But, and this is the key, if those undiscounted future cash flows are less than the carrying amount, that's your trigger. Impairment is indicated. You must go to step two.
Okay, can we use an example just to make that crystal clear? Let's say there's a machine.
Sure. Let's imagine a company has some specialized equipment. Its carrying amount, book value, is $600,000. They look ahead, they do their projections, and they figure the total undiscounted cash flows it'll generate over the rest of its life, including maybe selling it for scrap at the end, is only $580,000.
Ah, okay. Less than the carrying amount.
Right. Since $580,000 is less than the $600,000 book value, even without considering the time value of money, it fails the test. Impairment is indicated. They absolutely have to move on to step 2 to figure out the size of the loss.
Now, this is where it gets really interesting, that detail you stressed. Undiscounted cash flows for step 1. Most finance folks immediately think discounted cash flow, right? Present value. Why is it so important that this first check uses undiscounted flows? What's the logic there?
That's a really sharp question. It's a deliberate feature of US GAAP. Using undiscounted cash flows makes this first test, well, frankly, an easier hurdle to clear. It's a broader screen. It's basically asking a very simple question first. Look, forgetting about interest rates or inflation for a second, can this asset even bring back the raw dollars we have it listed for on the books?
Kind of a basic viability check.
Exactly. Can we get our initial investment back, period? If the answer is no, even on that simple basis, then you definitely have a potential problem that needs closer inspection. It acts as a quick filter. It identifies potential issues before diving into the more complex and often subjective fair value calculations needed for step 2, which do involve discounting, like a first-pass sniff test.
Okay, that makes sense. A quick check first. So if the asset fails step 1, those undiscounted cash flows don't cover the carrying amount, what's next? How do we nail down the actual loss amount? This feels like where the actual calculation happens.
That's exactly it. This is step 2, measuring the impairment loss. Once you fail the recoverability test, you calculate the loss. And the formula is pretty straightforward. Impairment loss equals the carrying amount minus the fair value of the asset.
Carrying amount minus fair value. Okay, how do they get that fair value number?
Good point. Determining fair value is key here. Ideally, you look at the market price. If there's an active market for that exact asset, like, say, a standard type of truck, you use that price. Easy. But often, especially for specialized equipment or unique property, there isn't an active market. So companies have to estimate fair value, and a very common way to estimate it is by using the present value of those future net cash flows we talked about. But this time, you apply an appropriate discount rate.
So the discounting comes in here in step 2, not step 1.
Precisely. This is where the time value of money matters for the actual measurement of the loss.
So let's go back to our machine. $600,000 carrying amount, failed step 1. What would the loss be in step 2?
Right. So carrying amount is $600,000. It failed recoverability. Now for step 2, let's assume the company determines its current fair value, maybe through discounted cash flows, maybe an appraisal is $525,000. The impairment loss is then $600,000, carrying amount, minus $525,000, fair value, which equals $75,000. That's the impairment loss they need to record.
Okay, $75,000 loss.
And what's really insightful, I think, is seeing that shift. Step 1 uses undiscounted cash flows for a broad screen. Is there potentially a problem? Step 2 uses fair value, often based on discounted cash flows or market prices for precision. Okay, exactly how big is the problem? It reflects the different jobs each step has to do.
Got it. Identified the problem, calculated the exact damage, $75,000. Now, the practical part. How does this actually hit the books? What's the journal entry? What does it do to the financials?
Okay, so when that $75,000 loss is recognized, the company needs to make an accounting entry. It basically does two things. Reduces the asset's value on the balance sheet and records the loss on the income statement. Think of it almost like a big sudden depreciation charge, though it's technically different. The entry would be a debit to loss on impairment for $75,000.
Okay, that hits the income statement.
Right. And a credit to accumulated depreciation equipment for $75,000, or sometimes directly to the asset account itself. But crediting accumulated depreciation is common as it reduces the net book value.
So the net effect is the asset's book value drops by $75K.
Exactly. The net book value on the balance sheet goes from $600,000 down to the fair value of $525,000.
Yeah.
And crucially, that $75,000 loss flows through the income statement, reducing the company's profit for that period.
And for us, looking at the financial statements, where would we typically find this? Because spotting it and understanding it seems pretty key for analysis.
Absolutely. On the income statement, you'll usually find impairment losses reported down in the Other Expenses and Losses section. It's typically part of income from continuing operations, but separated from core operating costs like COGS or SG&A.
So it stands out a bit.
It should, yeah. But maybe even more important than where it is on the income statement are the notes to the financial statements. Companies are required to provide pretty detailed disclosures about impairments.
The footnotes. Always got to read the footnotes.
Always. These notes are vital. They have to describe the impaired asset, explain why the impairment happened, the events or circumstances. Was it new tech, a downturn, a pandemic? They also have to state the exact amount of the loss and, critically, how they determined fair value. Did they use market prices? Discounted cash flows? If so, what discount rate did they use?
That level of detail sounds incredibly useful.
It is. It gives you the story behind the number. Think about Macy's, for example. In their 2020 report, they disclosed something like, during 2020, primarily as a result of the COVID-19 pandemic, the company incurred non-cash impairment charges totaling $3,280 million. That's billion with a B, to adjust the carrying value of certain store locations to their estimated fair value.
Wow. $3.28 billion. And they explicitly link it to the pandemic.
Right. That disclosure tells you not just the huge number, but the cause. It shows how a massive external event forced a fundamental revaluation of their store assets, gives crucial context.
Yeah, that really brings it home. Seeing the disclosure like that, it's not just an accounting entry. It makes you think, right, about their strategy, the future of retail.
Exactly. It allows stakeholders, you, me, investors, to understand the why they hit, what assets, how bad is it really. It prevents companies from just burying these big adjustments.
Okay, now here's something I know trips people up, and it's a really key difference in US GAAP. What if things get better? Say that machine we impaired down to $525,000. What if next year the market recovers, or a new use is found, and its fair value bounces back up to, say, $580,000? Can the company reverse the impairment loss they took? Can they write the asset back up?
The reversal question. Under US GAAP, for assets the company plans to keep using assets held for use, the answer is very clear. And no.
No reversal at all.
No reversal is permitted. Once you've recognized that impairment loss for an asset held for use, that's it. Even if its fair value subsequently goes up, you cannot restore the previously recognized loss. That new lower carrying value, the $525,000 in our example, becomes its new cost basis for future depreciation. It's a permanent write-down for accounting purposes.
So using a different example, like the Kodak one you mentioned earlier, if they impaired something from $500 down to $400K.
Right. And later its fair value recovered to, say, $480,000. Doesn't matter under US GAAP. No adjustment is made. It stays on the books based on the $400,000 impaired value, less any depreciation taken since the impairment.
Why such a strict rule? What's the thinking there?
It really comes down to conservatism in accounting. The idea is to prevent potential earnings manipulation. If companies could write assets down and then write them back up whenever fair value fluctuates, it could create volatility in earnings that might not reflect long-term operational reality. It basically says, you made the call that this asset's value was permanently reduced, stick with it. It avoids companies potentially boosting profits by reversing prior losses. It forces a more, committed assessment of value.
That no U-turn rule is definitely significant for assets they plan to keep. You made your bed, essentially. But what if they don't plan to keep using it? What if, after impairment maybe, they decide, you know what, we're just going to sell this thing? Does that change the rules? That feels like a different situation entirely.
Yes, it absolutely does change things. If a company decides to sell an asset and it meets the criteria to be classified as held for disposal, then different rules apply. These assets aren't measured at carrying amount or fair value anymore. They're reported at the lower of cost or net realizable value, NRV.
Net realizable value. How's that different from fair value?
It's close. NRV is the estimated selling price, the fair value minus any costs expected to actually sell it, like broker commissions, closing costs, that sort of thing.
Okay, fair value, less cost to sell. Makes sense for something you're about to sell.
Right. And another really important difference, assets held for disposal are not depreciated.
Oh, why not?
Because the company isn't using them anymore to generate revenue in the normal course of business. They're essentially holding them like inventory, waiting to be sold. So depreciation stops.
Got it. Lower of cost or NRV and no more depreciation. Any other differences? Can you write these assets up or down?
Yes. And this is the other key distinction. For assets held for disposal, companies can adjust the carrying value up or down in later periods if the NRV changes. So if the estimated NRV goes up, you can write the asset value up. If it goes down, you write it down.
Ah, so reversals are allowed here?
Write-ups are allowed, yes, with one major limitation. You can never write the asset's value up above its original carrying amount before any impairment was ever recognized.
Okay, so you can recover previous write-downs related to NRV changes, but you can't go higher than its original book value pre-impairment.
Exactly. And any gains or losses from these adjustments to NRV for assets held for disposal are reported in income from continuing operations.
That really clarifies the difference. It hinges entirely on the company's intent for the asset, doesn't it? Use it or sell it.
Precisely. That's the core logic. If you're holding it for use, The accounting reflects its long-term diminished utility, with that strict no-reversal rule promoting conservatism. If you're holding it for sale, the accounting shifts to reflect its current marketability, its NRV, which can fluctuate. So the rules allow for adjustments up to that original cost ceiling. It's tailored to the plan for the asset.
Wow. Okay. That was quite the journey, but I feel like we've really mapped it out. From spotting the warning signs through the two-step test, understanding how the loss is measured, how it hits the income statement and balance sheet, the critical importance of those note disclosures, and then that really key split between assets held for use with the no reversal rule versus assets held for disposal, which have more flexibility. It really drives home why these adjustments happen and where you find the story.
Absolutely. And hopefully it shows that understanding impairment isn't just, ticking an accounting box. It gives you real insight. Insight into a company's financial health, how management views the future of its assets, how they're responding to market changes. It's a powerful lens to see beyond just the historical cost numbers. It reflects economic reality, sometimes hard reality.
So let's leave you with this thought. Next time you read about a company taking a big impairment charge, and you probably will, it happens all the time. Stop and think. What does that charge really tell you? Is it a sign of a company proactively adapting, maybe shedding old tech or getting leaner? Cleaning house? Or does it maybe hint that management was perhaps too optimistic before and now reality is forcing their hand? How does knowing these rules, especially the no reversal part for assets they keep, change how you interpret that company's financial narrative? It's more than just a number. Keep digging, keep analyzing.
Thanks so much for joining us on this deep dive into impairment loss.